Welcome everybody. Welcome to Making Money in the Markets with VectorVest. My name is Russell Markham and I'm the Director of Education for VectorVest. Let's just transition the screen. There we are. So you'll see me now on the screen. So thanks for coming along today. It's all about making money in the markets with the power of VectorVest. So really pleased to have you along. A few of you asked in the week there, you know, what's my background? My background there, I studied commerce at university. I did an economics and accounting 4-year commerce degree, and I went to work for a big oil and gas company. So I got a lot of good financial analysis skills there, and I went on to work for a couple of the big banks, both here in Australia and also big insurance companies in Hong Kong. I've come back to Australia 14 years later after a couple of years in Hong Kong, and my passion is making money in the markets, and I've seen the best and the worst of the markets. I've made all the mistakes there are to make, and I've got it right in later years, and I want to share with you the tools and the power that I use to really get ahead in the market. So very excited to have you here along today. Oh, and also threw in a Masters of Financial Planning for good measure. I thought I wanted to be a financial advisor. I really did enjoy it. But then I found VectorVest, and that changed everything. So welcome. You're in the right spot today if you're all after wanting to find money in the market. All right, with that said, let's get into it. So first and foremost, please note the license numbers here. There are authorized license numbers there. I'm not licensed to give you personal advice. I cannot give you personal financial advice. I can only give you general advice. So as long as we're all clear with that today, it'll be general advice only. And as always, past performance is no guarantee of future results. Let's jump right into it. So today, what I want to do, and I'll just bring the camera back onto me. Today I want to talk to you about finding top dividend stocks. All right, so top dividend stocks where I'm going to take into account franking credits. All right, so for you here, of course, in Australia, if you're watching offshore, you might not be eligible, and I can't advise you from a tax perspective, but we have this wonderful regime here in Australia called franking credits. And what that means is that you can get the money back in your hand in terms of what the company's paid, corporate tax. So if the company's paid 30% corporate tax on dividends, and those dividends are then distributed to you, the recipient of those dividends, you're able to claim those as imputation credits. So not only do you get the dividend, you also get the imputation credit associated with the dividend. All right, so I'm going to show you why Australia is effectively the best dividend paying country in the world thanks to franking credits. All right, so with that said, let's move myself back over. Let's jump out of here, and I'm going to cut straight to the chase. Now this might be a tad difficult to see. Let's see if I can blow it up a bit here. And as I get better and better with all this, I'll be able to get better tools. All right, so bear with me. Early days with this channel. I'll make sure I can work out how to zoom it in and be better in that regard. So hopefully this is a little bit easier for you to see here. Can I zoom it in a bit more? So what I'm going to do here, and you don't need to be a computer programmer, you don't need any of that. You just need to simply be able to point and click with your mouse, and you can build just about anything that you're looking for in VectorVest. So what I've done in VectorVest, I've gone to this tool called Unisearch, and Unisearch will therefore allow me to find certain parameters. So the parameters I'm looking for here is I'm looking for a fully grossed up dividend yield. So what do I mean by that? Fully grossed up dividend yield. So if a company's paying me a dividend, let's say of 3%, and then I get, say, franking credits of another 1%, the fully grossed up dividend yield will therefore be the dividends plus the franking credits. So that's what we mean there. What are we getting in terms of a dividend and in addition to a franking credit? So in this example here, I'm going to be saying to VectorVest for Australia, go and ensure that all the stocks that you return to me are fully franked, both interim and final franking credits, IFC interim franking credits and FFC final franking credits. Make sure all those dividends are fully franked, and make sure that the fully grossed up dividend yield, so that being the dividend yield plus the franking credit, is going to be greater than or equal to 7%. 7% or more. How attractive is that? So let's put the camera on here for extra effect. So if I'm a retiree, or I'm looking for dividend yield, I'd be somewhat foolish to ignore the benefits of franking credits. I'm not saying that all fully franked stocks, so in other words, companies that are giving you a dividend and a franking credit imputation, I'm not saying that all fully franked dividends are worthy, but what I am saying is that we would be foolish not to consider the benefits of franking credits and dividends where we can find a stock that really stacks up. And so that's the aim here. Can we find it? And, I would rather go for a reliable, good quality stock that's paying, let's say, a 4% dividend yield than going for a stock that pays a 4% dividend yield plus another, say, 2% franking credit where that stock is not a particularly good stock to hold. All right, so, all I'm saying is we just want to temper it with a bit of common sense here to make sure that it's all stacking up. Now, if I can find a good dividend yielding stock where there's good franking credits on offer, then that's a win-win. That's really what I'm after. So can I do it? So what I've said to VectorVest here is go and find me the fully grossed up dividend yield of 7% or more. Make sure that the dividend's being paid. So this is an indicator we have in VectorVest, proprietary to VectorVest. It's a beautiful indicator if you are seeking dividend paying stocks. Dividend safety. How safe and reliable and consistent have your dividends been? And so what VectorVest does is it puts it on a scale of 0 to 99. And anything over 50, we've found in Australia to be very reliable for meeting or exceeding dividend obligations. All right, so, or at least on offer, the dividends on offer. If you're getting a dividend safety score less than 50, you want to be careful. If you can get a dividend safety score of 60 or higher, you've got a very good track record in terms of that stock of meeting or exceeding dividend expectations. All right, or at least on offer, the dividends on offer. So that's good. And then we've made the franking credits fully franked. Right. And then we sort all the stocks by the best combinations of fundamentals and technicals. Right. So drum roll, let's roll it out. 24 June, I'll run the search. Now what I'm going to do here is I'm just going to tidy this up just a bit, just to make it a little bit neater for us. Let's pull this one out just a little bit here. Now, first up, Fleetwood. So Fleetwood meets a fully grossed up dividend yield of 7.46. Now, to our subscribers in attendance today, if you're wondering, well, hang on, how did you get this FGUDUI fully grossed up dividend yield column? Make sure you come along to the Online Investment Club this Saturday, and I will go through all of that. So this Saturday, remember, to our subscribers, we start at 9:30 sharp, Sydney time equivalent. Can't wait to share with you. I'm going to go through a lot of dividend and franking credit type analysis on Saturday, and you'll walk away with some very good analysis with some stocks there to consider. Okay, so I'm just scratching the surface here today. If you're not already a subscriber, take out a trial. Come along to the Online Investment Club on Saturday. We do it the fourth Saturday of every month. So that said, let's transition across here. So the first one here, Fleetwood, fully grossed up dividend yield. So that's that column I'm talking about, 7.46%. All right, so good. The dividend yield, I should probably put this one next to that one. It would make better sense. Let's just tidy that up. Okay, so we've got a dividend yield of 5.22% plus a franking credit component of 2.2. You add the two up together, it gives you a fully grossed up dividend yield of 7.46%. So where a company is fully franked, yes, the dividend on offer is about 5%, but if it's fully franked, you're also getting a roughly another 2% on franking credits. And so therefore, you're actually earning closer to 7.5% on Fleetwood at the moment. And so that's why, welcome to Australia, some of the juiciest dividend paying stocks you'll ever hope to see globally. In fact, one can argue, I think there was an article put out the other day by, if my memory serves me correctly, by Morningstar, basically saying Australia is basically the best dividend paying stocks in the world. And this is why, because the franking credit really kicks in. So for Australian tax residents, you're enjoying the benefits of franking credit. So you're not getting a 5.2, you're actually getting closer to a 7.5%. IVE, all right, the fully franked amount, look at that, 9.46%. 9.46, just shy of 10%. And you might be looking at that and thinking, well, is this too good to be true? Well, we're going to investigate further. So here we're getting a whopping dividend of 6.62. And if that's not good enough, you're getting another 2.8%. There's a lot of stocks that don't even pay 2.8% on a dividend, let alone a franking credit. But you're getting a whopping 2.8% on franking credits to give you a 9.46. And yes, the safety track record, I failed to mention this one, Fleetwood was 72 out of 99, very, very good, excellent score. Another excellent score here for IVE Group at 61 out of 99, very, very good track record. Next one here, WAM Global Limited, fully grossed up dividend yield 7.26, not bad at all, 5% on the dividend, another 2% on the franking credit. With a very good safety track record. Coming into here, NRW. Now, nothing to sneeze at. 54, still a very good score. These are excellent scores, over 60, 60 or higher. This is still very, very good. All right, so it's a very good score. 7.73, 5, just on 5.5% for the yield and just over 2% for the franking credits. Not bad at all. And then WAM Microcap. So two of the WAM ones featuring here. WAM Microcap, look at that, fully grossed up dividend yield, my goodness, 10.44%. A whopping 7.31 on the dividend, and a whopping 3.1 on the franking credit to give you a 10.44. All right, and a safety track record, which is very good, at 57. All right, so you're looking at this, well, you know, these are very, very attractive, but, you know, what's the catch? Well, let's see. Is there a catch? If you're buying these companies and you're getting, you know, a fully grossed up dividend yield of, you know, 7.46% in this case, you know, but the company's falling 20% a year, well, you're not really going ahead, are you? You're getting 7% on dividends. Yep, great. But you're losing 20% on capital. And so the net effect is you're actually down 12, 13%. What if you could get a company like Fleetwood where the fully grossed up dividend yield being paid out as, say, 7 and a bit percent, and the company goes up 10% for the financial year? Now you're talking. You've made 10% capital growth. You've made another 7% on the fully grossed up dividend yield. So the question then is, well, which one of these companies are going up? Which one of these are faltering? And the only way to really see this best is to graph them. So let's graph them. Let's have a look. So here we go. And so what I've done here, I'm going to put on the fully grossed up dividend yield. All right, and I'll make this 100%. The reason I've noted must be franking credits must be 100%. It's just to remind me to make sure that, of course, that I'm looking only at the fully grossed up dividend yielding stocks. Right, so looking at Fleetwood, here's a fully grossed up dividend yield of 7.46%. Let's just minimize this to make it cleaner. So that's the fully grossed up dividend yield. And let's see how it's been tracking. So it's been tracking pretty well in recent times. There, it sort of dipped down. It went, wow, look at that. It was as high as 15% at one stage, and then it came off. And did I read that correctly? No, I didn't read that correctly. Sorry, 11%. 11% at one stage. And then it came off, and it basically went to zero, which I don't like the fact that it dipped all the way to zero and then started ticking back up again. But having said that, at this point in time, this is where I'm looking to invest. So I need to look at what's in front of me now. Historically, yeah, you know, a few question marks. We dipped down to zero dividends, but it's picked up again. But right now, you know, it's doing what I want it to do. It's giving me a grossed up dividend yield of over 7%, and it's climbing, and the share price is going up. So for argument's sake, if I bought it, let's say back here on October, I wouldn't have because it was a sell rating at that time, but let's see where things picked up. So there you are. That's where the buy kicked in. All right. And it's a rating. I'm not saying you rush out and buy it, but you know that I wouldn't want to buy a sell rated share using VectorVest. So at this point here, this was a time to consider. I'm not saying what you should and shouldn't do. I can't advise you personally. But he had $1.70 and it's gone up to $2.68. So, you know, if I'd held it from that time period, what is that? $2.68 minus $1.70 divided by 2.68 as a percentage. What's that? It's a 36% return, right? So the share price went up. Okay, it dipped a bit, but it went up 30-odd%. Not only that, not only did the share price go up 30%, but the fully grossed up dividend yield had kicked in at 7.5%, just shy of 7.5%. Well, so that's the first one. Well, okay, but what do the other ones look like, and are they worth considering? Well, let's look at this IGL. The yield, fully grossed up dividend yield, has been dropping, and if I look at the dividend yield component, let's just make this jump out a bit more. It's a bit difficult to see. Here we are. Let's make it stand out. So the dividend yield has been falling, but you can see it's gone from a dividend yield of 9%. So this number here, 9%, and it's fallen all the way down. When I say all the way down, tongue in cheek here, to 6.62. Shock horror. That's still a very, very attractive dividend yield, is it not? Right. So, okay, it has been falling a bit because the share price has been rocketing up, and I don't think the actual dividends being paid are keeping up with the rate of increase. Let's see. So here are dividends being paid. So dividends are being held constant. When a share price goes up, but the dividends remain constant, it impacts on the yield. That's why the yield falls, because the way the yield is calculated, it's the dividends divided by the share price times 100. And so if your dividends remain constant, but your share price, your denominator, so your numerator remains constant, that being the dividends divided by the denominator, which is the share price, but the share price keeps going up, then that's why the yield drops. So if the dividend had kept moving up along with the share price, then your yield may have remained somewhat constant or increased if the dividends had increased relative to the share price increase. But nonetheless, it doesn't matter. You're still getting a very attractive 6% dividend yield. You then throw in the franking credits, and you get the fully grossed up dividend yield, and that comes right now at the moment at 9.46%, give or take roughly that amount at the moment. So still very good, very, very good. And so if I pull it back over time, let's see and so this is over the last 3 years. Where was the low point? It dipped down to 9% fully grossed up, and it spiked all the way up to here, a fully grossed up dividend yielding amount of 15%, and now it's back down to 9.46. So looking at what's currently in front of me, well, this is falling, and there is the risk that it could keep falling further because it doesn't look like they're increasing dividends. But the share price keeps going up. But hang on, if you take a step back and look at it all, so you've averaged around, let's say you're on track to get, let's say it keeps falling, but maybe it'll average over the next 12 months 8%. So let's say it drops from 9.46 on average down to about 8%. But hang on, even if you got 8%, look at the growth on the actual share itself. So the share's gone from $2 to $2.72. So what's that? 0.72 divided by $2 times 100. And this one here has also gone up 30-odd%, 36%. So over the last 1 year, 6 months, 18 months, it's gone up 36%. And you've been getting on average about 9.5% for the year for a fully grossed up dividend yield. It's not too bad. If I pull it back a little bit further and have a look, wow, see how it spiked and then it fell away, but it looks fairly sort of constant. If you sort of, let's do this, let's put in a horizontal line. What has it averaged? I'd say it's probably averaged around about here, probably about 8 or 9%. So the question is it going to keep doing that? If it keeps averaging around about that 8-9% fully grossed up dividend yield, and provided the share price doesn't crash, it keeps moving up or at least hold steady, then that seems to be a fairly decent 9% fully grossed up dividend yield potentially. Now again, just put the camera on here for me for extra effect. We're all clear. I cannot give you personal advice. I'm not saying go out and buy IGL. I don't know whether it's right for you or not. You need to speak to your financial advisor. You need to make that decision. I'm not saying what you should and shouldn't do. I don't know your circumstances. All right, so just be clear on that. All right, general advice only. All I'm saying right now, how it stacks up, is that IGL looks like it's been holding pretty steady at that pretty decent 9 to 10% fully grossed up dividend yielding amount. All right, next one here, WGB, WAM Global Limited. I really like how constant, let's zoom it in a bit here, grab my date line. I really like how constant the fully grossed up dividend yield has been. You know, sure, it spiked up a bit there, but it's been fairly smooth over the last 3 years. And if I put that horizontal line in, yeah, give or take, I'd say it's averaged quite comfortably that amount, right? So what's that? It's about 8%, right? So done around about 8%, quite constantly. I like the fact that I don't like the fact that the share price fell heavily there, but it looks like now things have turned the corner and it's resuming a pretty decent uptrend, resuming up again. So in this particular case here, 2 years and 11 months, so just on 3 years, it went from what, $1.80 to $2.46. Let's look at it over the last year. So if you bought it a year ago, $2.21, it's now $2.46. All right, so it's held steady. It's up, you know, what's that? About 0.2 divided by 2. Yeah, it's up what, 8 to 10%. So you've maintained your capital 8 to 10%, and you've got that fully grossed up dividend yield there of around about 7%. So very nice. You know, you've maintained your capital and you've got a pretty decent fully grossed up dividend yield. Next one here, NRW Holdings. Now, do you see what I see straight away? Would you have been comfortable holding this over the last year? I probably wouldn't have been. I'm sure it started off okay, $3. It went up to $3.87. Yeah, I'm feeling pretty good, up 15, 20%. But then this happens and it falls all the way to $2.96. So going back a year ago, we bought it at $3. It's now down to $2.96. So in this particular example here, your capital hasn't grown. Now, a few of you might be saying, well, it doesn't matter. I bought the share because I wanted this juicy, fully grossed up dividend yield of 7%. And I pretty much got it. All right, but you didn't grow your capital. So I want both. I want capital growth and grossed up dividend yield. So it depends what you're after. But at least over a year ago, you didn't erode your capital. You pretty much sort of ended up where you started. But you were on track to make some pretty juicy dividends. But, you know, what I like to do is I like to go back and look at the trend. Now, what has the general trend been? Yes, typically it's been up. It can be a bit bumpy at times, but the general trend, if I do a freehand line here, the general trend has been sort of up. All right, so it's not too not too bad, not too bad a trend. Right, so it's been trending up. And if I do the horizontal line here, best sort of fit, just roughly eyeballed here. It looks like it's averaging about 6.5% fully grossed up dividend yield. So it's not a bad one at all. It's not a bad one at all. If you can stomach some volatility. So it's a bit more volatile than, say, WGB in recent times. You know, if we look at in recent times here, that's been a bit of a smoother trend. This one here has been a bit choppy as well. It's a bit up and down. And this one here has bounced around a little bit too. Okay, so, pick the one that works best for you in terms of a profile that works best for you. Well, if you're not after a lot of volatility, WMI looks like it's, funny enough, it's probably, the last one is actually probably the least volatile. Yes, sure, it looks terrible the way it's bouncing up and down on a daily perspective, but hang on. It's only bouncing between, say, 170 and 145, 150. So that's actually quite a narrow band. It's just the way the graph comes across. But if you look at that sort of band, it's not actually that volatile. So it sort of bounces in between the support and resistance lines here. What's really interesting on this one here is on the fully grossed up dividend yield component. It looks like it's doing around about 10% fully grossed up dividend yield. If you look at a best fit type eyeball line, I guess, for a better term, over the last 3 years. So it looks like it's grossing up close to 10% with fairly low volatility. Now, you're not really getting capital growth, but you're getting a pretty decent 10% fully grossed up dividend yield. Interesting, right? All right, let's close out of here. I'm gonna just do one last twist here, just in wrapping up. All right, so we just about finished. I'll do one last twist, We've got this indicator in VectorVest called the Comfort Index, CI. The Comfort Index. How comfortable are you in holding on to that stock? So CI, it's looking for stocks testing new highs and resisting severe and or lengthy price declines. And with all of our key indicators and VectorVest key indicators, it's on a scale of 0 to 2. So as you guessed, yep, greater than or equal to. And here I'm going to make it very strict. I'm going to say 1.4. So what that'll do now is it'll make sure that I'm finding, I'll just crunch these up just to make it a little bit neater for us. I'll just pull it right in. I'm going to ensure that I'm looking for some pretty smooth stocks. Now we looked at Fleetwood, IV. So what you can do is you can come down here and just pick on ones where you've got a very high CI score. Now this one here, forget the fully grossed up dividend yield for now. This has got a very high CI score. So it means on average, it's a pretty smooth stock. Now it's looking in recent times. So here, that's pretty decent, right? Sure, a few little pullbacks here and there, but the general trend has been very nice in terms of an upward momentum. Now, if I pull on the fully grossed up dividend yield, it's been falling because it looks to me like the dividends haven't been keeping up with the share price. They've been remaining constant. So hence the yield does come under pressure. But nonetheless, it's still doing, just shy of 10%. It's doing what? Not 9% currently. So even if it were to drop to 6 or 7%, you're still getting a grossed up dividend yield potentially in the next 12 months of 6 or 7%, while it looks to me like capital growth appears to still be on the cards. And so just out of interest, over the last year, if I'd bought it, let's say here a year ago, $1.36, and is now $2.36. So what's that? 1 divided by 1.336 times 100, whoa, 73%. So the share price went up 70%, and you still got around about 8 or 9% on a fully grossed up dividend yield. Now that, to me, is smart investing. I'm getting capital growth, and I'm getting decent dividend yield. And so if you're a retiree investor, the question I will pose to you today is, why not go for both? Why not go for capital growth and dividend yield? You can get capital growth and dividend yield, and it's about looking and screening for the type of stocks that best suit you and your temperament and what works for you. But for me, when I'm looking for stocks for dividend purposes, I also want to get the capital component. So I hope today helped. I hope what I've shown you resonates. If you're not already a subscriber to VectorVest, why not become a subscriber? Take out a trial, www.vectorvest.com.au, and you can't miss it. There's a link there to take out a trial. Just subscribers, I will see you on Friday for the Q&A and then Saturday for the online investment club. So I look forward to seeing you then. Until next time, so same time, same place next week, Wednesday at 11 a.m. equivalent. Come along. If you've got questions, bring the questions along too. Bring your friends, your family, whoever you want to the YouTube. Refer this video on. I hope you got a lot out of it. Thanks again for your attention today. We'll see you at the next one. Bye for now.